I have spent over 70 years studying markets, analyzing businesses, and trying to understand the patterns that govern how wealth is created and destroyed. In those 7 decades, I have lived through multiple recessions, several major market crashes, periods of inflation and deflation, wars and peace, booms and busts. I have seen almost everything that can happen in financial markets. And I can tell you that what I am seeing right now as we move through 2025 and approach 2026 concerns me more deeply than almost anything I have witnessed in my entire career. This is not a casual observation. This is not me being cautious or conservative or overly worried about risks that probably will not materialize. This is me telling you as clearly and directly as I can that the confluence of factors I see in the economy and in financial markets right now represents a genuine threat to the financial well-being of millions of Americans. And most people are not paying attention. Most people are going about their business, making investment decisions, planning their retirements, managing their money, as if everything is normal. But everything is not normal. Let me start by telling you what I am seeing that has prompted this warning. And I want to be very specific, very concrete, because vague warnings about unspecified dangers are not helpful to anyone. I am going to walk you through the specific indicators that concern me, the specific risks I see building in the system, and the specific actions I think people should be taking to protect themselves. The first thing that concerns me is the level of valuations across almost all asset classes. Stocks are expensive by almost any historical measure. The S&P 500 is trading at price to earnings ratios that are well above historical averages. The Shiller-Cape ratio, which looks at price relative to 10-year average earnings, is in the top 10% of its historical range. This does not mean stocks will crash tomorrow. Markets can remain overvalued for years. But it does mean that forward-looking returns are likely to be much lower than what investors have gotten used to over the past decade. But it is not just stocks. Bonds are offering yields that, after accounting for inflation, are barely positive or even negative in many cases. Real estate prices in most major markets are at or near all-time highs relative to rents and incomes. Private equity is paying prices for businesses that assume everything goes perfectly for the next decade. Even alternative assets like art and collectibles have been bid up to levels that seem disconnected from any reasonable assessment of their intrinsic value. When everything is expensive simultaneously, when there are no obvious bargains anywhere in the financial markets, that tells you something important. It tells you that there is too much money chasing too few opportunities. It tells you that investors are taking more risk than they realize because they feel they have no choice, because leaving money in cash feels like falling behind. It tells you that the margin of safety, the cushion that protects you when things go wrong, has been stripped away. I have always believed that the most important rule in investing is not to lose money permanently, not to have big drawdowns that take years to recover from, not to take risks that could impair your capital in ways you cannot come back from. And right now, I see investors violating this rule on a massive scale because they are chasing returns in overvalued markets without adequately considering what happens if things do not go as planned. The second thing that concerns me is the level of debt in the economy. Government debt, corporate debt, household debt, all at or near record levels. The United States federal government is running trillion-dollar deficits every year with no end in sight. State and local governments have pension obligations they cannot possibly meet without either cutting benefits or raising taxes dramatically. Corporations have borrowed enormous amounts of money at low interest rates to buy back stock and pay dividends, leaving them vulnerable if revenue declines or interest rates rise further. And households, while in somewhat better shape than they were before the 2008 financial crisis, still carry enormous amounts of student loan debt, auto loan debt, credit card debt, and mortgage debt. The average American household has more debt relative to income than at almost any time in history. This worked fine when interest rates were near zero and home prices were rising. But now interest rates are higher, inflation has eroded purchasing power, and many households are stretched thin. Debt is not inherently bad. Debt can be a useful tool for financing productive investments, for smoothing consumption over time, for taking advantage of opportunities. But debt becomes dangerous when there is too much of it, when it is used to finance consumption rather than investment, when the ability to service it depends on everything continuing to go well. And that is where we are now. The economy is carrying a debt load that is sustainable only if growth continues, if interest rates do not rise further, if asset prices do not decline significantly, if nothing goes wrong. That is a lot of ifs. What happens when an economy with too much debt hits a recession or a financial shock? The debt becomes unsustainable. Borrowers cannot make their payments. Defaults rise. Lenders pull back. Credit contracts. The economy spirals downward as the debt burden becomes crushing. We saw this in 2008 with mortgage debt. We saw it in the 1930s with all kinds of debt. We are setting up the conditions to see it again, but this time with even more debt spread across more sectors of the economy. The third thing that concerns me is the fragility of the financial system. Now, I know that regulators and policymakers have told us repeatedly that the reforms after 2008 made the system safer, that banks have more capital, that there are better risk management systems, that we have learned the lessons of the past. And to some extent, that is true. The largest banks are probably more resilient than they were in 2007. But the financial system is vastly more complex than it was even 20 years ago. There are more interconnections, more derivatives, more leverage hidden in places that regulators cannot see or do not understand. The rise of private credit, of non-bank lending, of complex structured products, all of this creates channels through which problems can spread in ways that are difficult to predict or control. I watched what happened with Silicon Valley Bank in March 2023. A seemingly healthy regional bank collapsed in 48 hours due to a combination of interest rate risk, deposit flight, and contagion effects. The regulators stepped in and prevented a broader panic, but it was a very close call. And Silicon Valley Bank was not even a particularly large or systemically important institution. What happens if we see similar dynamics at a larger institution or at multiple institutions simultaneously? The concentration in the banking system concerns me as well. We have a handful of very large banks that dominate the system. If one of them gets into trouble, the consequences would be severe. The government would probably step in to prevent failure, but that bailout would come with costs, with moral hazard, with the socialization of losses while profits remain private. And each bailout makes the next crisis more likely because it encourages risk-taking by institutions that believe they are too big to fail. Beyond traditional banking, I worry about the shadow banking system, the network of money market funds, hedge funds, private equity firms, and other non-bank financial institutions that perform bank-like functions without bank-like regulation. This sector has grown enormously over the past 2 decades, and it creates risks that are poorly understood and difficult to monitor. When stress hits the financial system, these shadow banks can amplify the problems rather than absorb them. The fourth thing that concerns me is the political and policy environment. I have never been particularly political in my approach to investing. I have worked with leaders from both parties. I have tried to focus on business fundamentals rather than political wins. But I cannot ignore what I see happening in Washington and around the world, and it concerns me greatly. The political system in the United States has become increasingly dysfunctional. The two parties cannot agree on basic facts, let alone on solutions to major problems. Every fiscal deadline, every debt ceiling negotiation, every major policy decision becomes a crisis that threatens to shut down the government or default on obligations or create chaos in markets. This is not a stable foundation for economic prosperity. Moreover, the policy tools that governments and central banks have traditionally used to fight recessions are largely exhausted. Interest rates, while higher than they were a few years ago, are still relatively low by historical standards. If we have a serious recession, the Federal Reserve does not have much room to cut rates before hitting zero. And once you are at zero, the effectiveness of monetary policy becomes questionable. Fiscal policy is constrained by the enormous debt burden I already mentioned. When the next recession comes, and it will come because recessions are a normal part of economic cycles, the government will want to increase spending and cut taxes to stimulate the economy. But with debt already at very high levels and deficits already in the trillions, how much fiscal stimulus can realistically be deployed? At some point, bond markets will rebel, interest rates will spike, and the medicine will make the disease worse. Internationally, the situation is even more concerning. Relations between the United States and China continue to deteriorate. The war in Ukraine drags on with no end in sight. The Middle East remains unstable. Supply chains that we assumed were reliable and efficient turned out to be vulnerable to disruption. Deglobalization is happening, with countries prioritizing self-sufficiency over efficiency, which will raise costs and reduce growth. Any one of these geopolitical risks could trigger a financial crisis if handled badly. A military conflict over Taiwan, an oil shock from Middle East instability, a complete breakdown in U.S.-China trade relations, any of these scenarios would have profound economic consequences. And the probability of at least one of these scenarios occurring over the next few years is uncomfortably high. The fifth thing that concerns me is what I see in investor behavior and market psychology. I have been investing long enough to recognize when markets are driven by greed rather than fear, by speculation rather than investment, by momentum rather than fundamentals. And I see all of those signs right now. Retail investors are trading stocks like they are lottery tickets, piling into whatever is hot, chasing returns without understanding the businesses they are buying. The meme stock phenomenon of 2021 was a warning sign that too many people view the stock market as a casino rather than as a place to own pieces of businesses. And while the most extreme excesses of that period have faded, the underlying mentality has not changed. I see it in the popularity of options trading, particularly very short-term options that are pure bets on price movements with no connection to long-term business value. I see it in the resurgence of interest in cryptocurrencies despite their lack of intrinsic value or productive use. I see it in the willingness of investors to pile into unprofitable companies. With compelling stories and no clear path to sustainable profits, professional investors are not immune to this either. I see pension funds and endowments reaching for yield in increasingly risky assets because they cannot meet their return targets with safe investments. I see private equity firms paying record multiples for businesses, funding those acquisitions with debt and hoping they can sell to an even more optimistic buyer in a few years. I see hedge funds using leverage and complex strategies to generate returns in a world where traditional sources of alpha have been arbitraged away. All of this works fine as long as markets keep going up, as long as liquidity remains abundant, as long as central banks stand ready to support asset prices at the first sign of trouble. But what happens when the music stops? What happens when markets decline and all of these leveraged, illiquid, speculative positions need to be unwound simultaneously? The answer is probably something very ugly, something that will surprise people in its speed and severity. The sixth thing that concerns me is inflation and the Federal Reserve's response to it. We went through a period of very high inflation in 2022 and 2023, the highest inflation in 40 years. The Federal Reserve responded by raising interest rates aggressively from near zero to over 5% in a very short time. This was necessary to bring inflation under control, and it appears to have worked to some extent. Inflation has come down from its peaks, but the job is not finished. Core inflation is still above the Fed's 2% target. Wage growth remains elevated. Housing costs continue to rise. And there are structural factors that could keep inflation higher than we got used to in the 2010s. Deglobalization means higher costs for goods. The energy transition means higher energy prices in the medium term, even if renewable energy is cheaper in the long term. An aging population means more demand for services and less labor supply. The Fed faces a very difficult choice. If they cut interest rates too soon or too much, inflation could reignite, forcing them to raise rates again later, which would be very damaging to the economy and to markets. But if they keep rates high for too long, they risk triggering a recession, particularly given the high debt levels I mentioned earlier. This is an almost impossible balancing act, and the Fed has a poor track record of executing it successfully. Looking at history, the Fed has never successfully tamed high inflation without causing a recession. Not once. The soft landing that everyone hopes for, where inflation comes down to target while the economy continues to grow, is extremely rare and difficult to achieve. The far more common outcome is that the Fed over-tightens, the economy goes into recession, unemployment rises, and only then does inflation fully come under control. I see no reason to believe this. time will be different. The seventh thing that concerns me, and this may be the most important, is complacency. Despite all of these risks, despite all of these warning signs, I see very little concern or preparation. Investors seem to believe that the government will always step in to prevent serious problems. They point to the interventions in 2008, in March 2020 during COVID, in March 2023 with the regional bank crisis, and they assume that pattern will continue forever. This faith in the Fed put, this belief that policymakers will always support asset prices and prevent serious downturns, has become deeply embedded in market psychology. And it creates a self-fulfilling dynamic where investors take more risk because they believe they are protected, which works until the day it does not work, at which point the consequences are catastrophic because everyone assumed they were protected and made no preparations. I remember the period leading up to 2008. There were warning signs everywhere. Housing prices were clearly in a bubble. Subprime lending was out of control. Financial institutions were over-leveraged and interconnected in dangerous ways. And yet most people ignored the warnings because housing prices had been rising for years, because the financial system seemed stable, because it was easier to assume everything would be fine than to prepare for problems. And then Lehman Brothers failed, and suddenly everything was not fine. Credit markets froze, stock markets crashed, the global financial system nearly collapsed. Millions of people lost their jobs, their homes, their savings. It took years to recover, and it could have been much worse if not for unprecedented government intervention. I see similar complacency now. People acknowledge that valuations are high, that debt is elevated, that risks exist, but they do not really believe anything bad will happen. They think they will see it coming and get out before things get ugly. They think the government will step in if necessary. They think this time is different. And that complacency is perhaps the most dangerous thing of all. Let me be very clear about what I am not saying. I am not predicting a crash on a specific date. I am not saying you should sell everything and go to cash. I am not saying the economy will collapse or that we are heading into another Great Depression. Market timing does not work, and I've never claimed to be able to predict short-term movements in stock prices. What I am saying is that the risk-reward ratio for most investments right now is very unfavorable. You are taking substantial risk for modest prospective returns. The margin of safety is thin or non-existent, and the probability of a negative outcome that could impair your capital for an extended period is higher than at almost any time in the past several decades. So what should you do? How should you position yourself given these risks? Let me give you some specific recommendations based on how I am thinking about these issues and how I am managing Berkshire Hathaway's portfolio. First, raise cash. Not all your cash, but more than you probably have right now. Cash gets a bad reputation because it does not generate returns when stocks are going up. But cash is optionality. Cash is protection. Cash allows you to take advantage of opportunities when they arise. And cash allows you to sleep at night when markets are turbulent. Berkshire is currently holding over $150 billion in cash and short-term treasuries, earning around 5% with essentially zero risk. That is not a bad return for something that is completely safe and completely liquid. You might argue that 5% does not keep up with inflation, that you are losing purchasing power by holding cash. And that might be true. But you know what else loses purchasing power? Stocks that decline 50% in a bear market. I would rather lose a little bit of purchasing power to inflation than lose half my capital in a market crash. Cash provides flexibility and peace of mind, and both of those are valuable, especially in uncertain times. Second, focus on quality. If you are going to own stocks, and I think you should own some stocks as part of a diversified portfolio, own the highest quality businesses you can find. Businesses with strong balance sheets, with little or no debt, with durable competitive advantages, with recession-resistant business models, with management teams that are conservative and thoughtful about capital allocation. These are not the exciting growth stocks that everyone is chasing. These are boring, mature businesses that generate consistent cash flows, that pay dividends, that have been around for decades and will be around for decades more. They are companies like Coca-Cola and Johnson & Johnson and Procter & Gamble. They are companies that people need, regardless of economic conditions, that have pricing power to offset inflation, that can weather downturns without facing existential threats. Quality businesses trade at premium valuations because everyone recognizes their quality. But in a downturn, they hold up much better than lower quality businesses. And over long periods, they compound wealth reliably. I would rather pay a fair price for a wonderful business than a cheap price for a mediocre business, and that is especially true when economic and market risks are elevated. Third, avoid leverage. This should be obvious, but I see so many people borrowing money to invest using margin in their brokerage accounts, taking out home equity loans to buy stocks, engaging in all sorts of leverage speculation. This is incredibly dangerous in any environment, but it is suicidal when markets are overvalued and risks are elevated. Leverage magnifies gains when things go well, but it magnifies losses when things go badly. And when things go badly with leverage, you can lose everything. You can be forced to sell at the worst possible time because you get a margin call. You can go bankrupt even though the underlying assets eventually recover. Leverage has destroyed more investors than bad investment decisions ever have. Do not use it, period. Fourth, diversify broadly, not just across stocks, but across asset classes, across geographies, across strategies. Own some stocks, own some bonds, own some real estate if appropriate for your situation, own some commodities or inflation-protected securities. Do not put all your eggs in one basket, and do not assume that what worked over the past decade will continue to work over the next decade. Diversification reduces risk without necessarily reducing returns. It protects you against being wrong about any single investment or any single outcome. It ensures that you participate in whatever works rather than betting everything on one scenario. This is basic risk management, and yet I see so many investors concentrated in a handful of positions or a single asset class because that is what has worked recently. Fifth, think about your time horizon and your need for liquidity. If you are young and saving for retirement that is decades away, you can afford to ride out market volatility. You can stay invested in stocks through downturns because you have time to recover. But if you are near retirement or already retired, if you need your money in the next few years, you cannot afford a major drawdown. You need to be much more conservative, holding more in cash and bonds, accepting lower returns in exchange for lower risk. Too many people approaching retirement are invested like they are 30 years old because they have gotten used to the returns from stocks and they do not want to give that up. But the risk of a major loss right before or early in retirement is devastating. It is called sequence of returns risk, and it can ruin a retirement plan even if average returns over your retirement are fine. Protect yourself by being more conservative as you get closer to needing your money. Sixth, control your emotions. This is the hardest advice to follow, but perhaps the most important. When markets are falling, when everyone is panicking, when it seems like the world is ending, that is when you need to remain calm and rational. Do not sell in a panic. Do not abandon your strategy. Do not make emotional decisions that you will regret when things eventually stabilize. Conversely, when markets are soaring, when everyone is making money, when it seems like stocks can only go up, that is when you need to be cautious. That is when you need to resist the temptation to chase returns, to abandon discipline, to convince yourself that this time is different. The best time to be greedy is when others are fearful, and the best time to be fearful is when others are greedy. This is one of my most famous quotes, and it is more relevant now than ever. Seventh, focus on what you can control. You cannot control what the economy does. You cannot control what the Fed does. You cannot control whether there is a recession or whether markets crash. But you can control how much risk you take, how much you spend versus save, whether you use leverage, how diversified you are, how much cash you hold. Focus your energy on the decisions that are within your control rather than worrying about things you cannot change. Eighth, make sure you have adequate insurance and an emergency fund. This is not investment advice, but it is financial advice. Make sure you have health insurance, disability insurance, life insurance. If you have dependents, homeowners or renters insurance, car insurance, all the basic protections that prevent a single adverse event from deriving you financially. And make sure you have at least 6 months of living expenses in an emergency fund separate from your investment accounts so that you can handle job loss or unexpected expenses without being forced to sell investments at bad times. Ninth, be skeptical of advice from people who have incentives that do not align with yours. Financial advisors who are paid commissions to sell you products, media personalities who need to generate clicks and views, friends and family who made money in some investment and want to share their success. All of these people may be giving you advice that is not in your best interest. Do your own research, think for yourself, make decisions based on your own circumstances and your own risk tolerance. And 10th, remember that the goal of investing is not to get rich quick or to beat the market or to have the best returns in any given year. The goal is to build wealth steadily over time, to protect your capital from permanent loss, to achieve financial security for yourself and your family. This requires patience, discipline, and a long-term perspective. It requires resisting the constant temptation to do something, to chase returns, to react to every headline and every market move. I have been investing since I was 11 years old. I have seen everything. I have lived through world wars and assassinations and impeachments and terrorist attacks. I have seen the Nifty 50 bubble, the inflation of the 1970s, the 1987 crash, the savings and loan crisis, the dot-com bubble, September 11th, the financial crisis, the European debt crisis, COVID, and through it all, the same principles that worked in 1942 still work today. Buy businesses at fair prices. Focus on quality and margin of safety. Be patient. Think long-term. Do not use leverage. Maintain adequate liquidity. Control your emotions. These are not exciting or complicated strategies. They will not make you rich overnight, but they work consistently over long periods in all kinds of market environments. And they are especially important now when risks are elevated and valuations are stretched. Let me tell you what keeps me up at night. It is not the possibility the Berkshire stock price might go down. It is not concern about my personal wealth or my legacy. What concerns me is thinking about all the ordinary people, the teachers and nurses and small business owners and retirees who have worked hard and saved diligently and tried to do the right thing, and who are about to lose a substantial portion of their wealth because they did not understand the risks they were taking. I think about the 65-year-old who retired in 2007 with a portfolio that seemed adequate, only to watch it decline by 50% over the next year, forcing them to go back to work or drastically reduce their standard of living. I think about the young family that bought a house at the peak of the market in 2006 with a mortgage they could barely afford, only to end up underwater and facing foreclosure when housing prices crashed. These are the people I worry about. These are the people I am trying to warn, because the risks we face right now are real, they are substantial, and most people are not prepared for them. And when the problems arrive, as I believe they will, the damage will be severe and long-lasting for those who did not take precautions. I cannot tell you exactly when these problems will manifest. Markets can remain overvalued for a long time. The economy can keep growing even with elevated risks. Policymakers might successfully navigate these challenges. All of that is possible. But the probability of negative outcomes is high enough, and the magnitude of those potential outcomes is severe enough that prudence demands taking action now to protect yourself. This is my most serious warning because I am not talking about routine market volatility or normal economic cycles. I am talking about the potential for a generational crisis, a period of financial dislocation and economic pain that could rival what we experienced in 2008 or even in the 1930s. The ingredients are all there. Excessive valuations, excessive debt, a fragile financial system, geopolitical risks, policy constraints, investor complacency. Any one of these factors could trigger problems. Multiple factors occurring simultaneously would be devastating. And I see multiple factors converging right now, creating a situation that demands extreme caution and defensive positioning. You do not have to believe that disaster is inevitable to recognize that the risk-reward ratio is very unfavorable and that protective action is warranted. I have spent my entire career trying to be rational, objective, and disciplined in my approach to investing in business. I do not make emotional decisions. I do not panic. I do not predict disasters that never materialize. When I issue a warning like this, it is based on careful analysis of facts and probabilities, not on fear or pessimism. And my analysis tells me that we are in a dangerous situation that requires urgent attention. You can ignore this warning if you choose. You can assume that I am too old, too conservative, too out of touch with modern markets. You can convince yourself that this time really is different, that the old rules no longer apply, that policymakers have learned how to prevent serious downturns. Many people will make that choice, and some of them will be fine, but many will not be fine. Many will suffer losses that permanently impair their financial futures. I do not want you to be one of those people. I do not want you to look back in 3 or 5 or 7 years and wish you had listened, wish you had taken action, wish you had protected yourself when you had the chance. That is why I am issuing this warning now, while there is still time to act, while you can still make choices that will protect your wealth and your financial security. The steps I have outlined are not complicated. Raise cash, focus on quality, avoid leverage, diversify, match your risk to your time horizon, control your emotions. These are common sense steps that any investor can take. They will not eliminate all risk. Nothing can do that. But they will substantially reduce your exposure to the dangers I see building in the system. And if I am wrong, if the problems I anticipate do not materialize, if markets continue to rise and the economy remains strong, you will have missed some upside. Your returns might be a bit lower than they would have been if you had remained fully invested in risky assets. I can live with that outcome. I would rather miss some upside than suffer devastating losses on the downside. I would rather be safe than sorry. This is not about timing the market. This is not about trying to sell at the top and buy at the bottom. This is about recognizing when the risk-reward ratio is unfavorable and adjusting your positioning accordingly. This is about being prudent, being defensive, being prepared. And right now, after looking at all the evidence, after analyzing all the risks, I believe prudence demands a defensive posture. I have issued warnings before over my career. I warned about the dot-com bubble in the late 1990s. I warned about derivatives in the early 2000s. I warned about housing and financial system risks before 2008. Not everyone listened to those warnings. Many people dismissed them as the concerns of an old man who did not understand new paradigms. And those people paid a very heavy price when the warnings proved accurate. I hope that this warning, my most serious warning yet, will be received differently. I hope that people will take it seriously, will consider the risks I have outlined, will take action to protect themselves. Because the stakes are too high to simply hope for the best. The potential consequences of inaction are too severe, and the steps needed to protect yourself are too straightforward to ignore. The choice is yours. You can take defensive action now while markets are still functioning normally, while you have time to adjust your positioning in an orderly way, or you can wait and hope that problems do not materialize, that the risks I see will not come to pass. I know which choice I would make, which choice I am making with Berkshire's capital, and I urge you to make the same choice for your own financial security and peace of mind. This is Warren Buffett issuing my most serious warning yet. The risks are real, the dangers are substantial, the time to act is now. Protect yourself, be prudent, be defensive, and may you weather whatever storms lie ahead with your capital and your financial security intact.